There's no plans for a staggered implementation period for the final rule. What that means is any application that is prior to August 1st, 2015 is closed under the previous forms. Any application that's taken August 1st, 2015 or after is closed with the new closing disclosure form. There's to be no variance. I can't say that they won't amend that in their, in the final rule. I would doubt it because that was such a huge issue in 2010. Technically, the HUD came out and said, hey, as of November 10th, I think it was, you can start using the new 2010 HUD, which caused all sorts of havoc industry-wide. People didn't have their software, people couldn't, some lenders were sending in the old stuff, some lenders were sending in the new stuff, so on and so forth. So the plan for this one is to not allow that, and to not even allow applications taken before August 13, 2015 to be converted over because they won't have the early loan disclosure form. They'd have a GFE, right, an early tail. So August 1st, 2015 is when you would start issuing the new loan disclosure forms, and then those particular transactions would close under the new closing disclosure form, and anything prior to that would close with the old forms. All right, so limits on tolerance. There is a few changes here. I'm not sure if you're aware of, but lender and broker charges, that's not new. Fees charged by an affiliate of the creditor now falls under zero tolerance. I don't know if you guys are aware of that. That's new. So if you are an affiliate, usually it's the title company that's an affiliate of the lender, of course, or if you have like an ABA arrangement, the fees for that settlement service provider are no longer under 10%, they're under zero. Basically they're saying if you're an affiliate of a company, you should know their fees, and therefore it's a zero tolerance. Fees charged by a service provider selected by the creditor. So if you tell a consumer, like we're going to order this from Appraisers RS, and you're going to get this from Termites, blah, 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 and this is the settlement company we're going to use. If you choose the provider, it's a zero tolerance for all service providers, not just fees associated with the loan. So if you tell them to use XYZ settlement services, that's now a zero tolerance, not a 10%. Charges for services in which the consumer is not permitted to shop for is where for example, where the consumer must select from a list of providers furnished by the lender. Okay? You guys have a list now, or at least some lenders do. But the two big ones were if it's settlement services provided by someone that the lender chooses, or if it's affiliate by the lender. Handled the same, cured the same, just now falls under a zero tolerance instead of 10%. Average cost pricing, different everywhere in the country. Anybody in here utilize average cost pricing? You're allowed to in the final rule. Real quickly, basically what it's saying, so are settlement agents, by the way, in case you see that fees change. What it basically means is, and this example is on a creditor, if a creditor wants to use average cost pricing, they can. However, they have to meet two requirements. One is which that fee has to be charged on that class alone, the same fee every time. So you can't just say, well, I'm going to use average cost pricing for this particular transaction, for this type of loan within this class. It has to be for that type of loan in that class for every transaction. That's your thing. You also can't just pull a number out of the air. It has to be documented where you got that number. So you can say, okay, well, in our last 100 closings, this particular fee for this type of loan within this class, the average, sometimes it was 200, sometimes it was 400, but it really was in between them all the time. So our average cost is going to be $300, and that's what we're going to charge for that fee for that particular loan within that class. You do not have to use average cost pricing. It's just allowed. It's very big out west in the West Coast, from the East Coast states, but it just needs to meet those requirements. Miscellaneous items. Two things that were in the proposed rule that have come out, and the reason why I note them is one is because it's really great that it's out, and one is because even though it's out, it's going to come back in. We'll do the bottom one first, because we hopefully won't see this come back in. What it is changes to the APR calculations. Originally, the proposed rule wanted the APR calculation based on, it was an all-in APR. It's basically the best way to explain it. All settlement fees, all closing fees, everything that is paid at closing, and all in APR, so not just loan-specific fees. So obviously, the more FDI and also we're like, no. The APR would change all the time then. Anytime a small fee changed at settlement, your APR was going to be changing. And remember, originally, that would have changed. We have the 8th now, but under the proposed rule, that 3-day rule would have restarted every single time that changed. So they took that out. They got so much feedback from the Mortgage Brokers Association, the MBA on that they yanked it right out. That we probably will not see come back in. The one above it, however, machine readable record keeping, will come back in. Machine readable basically means data points. It does not mean PDFs. It means, think of it like when you type something in your system, it's stored behind there somewhere. You don't know where, but it's back there. So originally it was that the lender or the creditor had to retain copies of the early loan, the loan disclosure form, and the closing disclosure form in machine readable format for every single closing. So basically what that means would be whoever's doing your closings would have had to electronically send you that data, no more PDFs, and then it would have stored in your system. Because we don't want to rekey anything, there's too much room for error, and the reason is for audit purposes. So at any point, the CFPB can tap into your system and see exactly what happened, make sure there was matching up, make sure all the requirements were met, and things were where they were supposed to be. That's all good and well, and definitely where the industry is headed anyway, with the new 5-page closing disclosure form having loan information and title information. However, the effort that goes into that will take years to get everybody to be able to do that. I mentioned it earlier. I mean, Wells, they can remember, you all have homegrown systems. So those top 5, 6 lenders, those are a year or 2 years just on those 6 lenders to integrate with. And then they're out-of-the-box systems like Calyx or Encompass or any of those. You know, those are easier. We're already actually integrated with several of them. They're easier, but there's still a lot of work in maintaining them. So we did specifically state in the final rule that while they're pulling this requirement from the August 1st, 2015 deadline, they will continue to research it and report back further. So this is essentially what I'm pretty sure is going to happen. So from August 1st, 2015, by law, the CFPB will have to provide a written report to Congress on the rollout and how this portion of the Know Before You Owe is working. How it went, what happened, is the industry better off, is the consumer better off, basically a report, a summation report after 5 years. And I can guarantee you that in that, they will recommend that they move forward now with the machine record keeping, saying the industry has had time to adapt, the software's had time to adapt, so on and so forth. Now we want this because we want to be able to audit, and Congress is going to say, sure, that's great, that's what we wanted in the first place. But they realized that if they would have required that, it would have pushed the whole implementation period back another 2 years, so that's why it's out. But it is definitely something that will be required at some point and something that we're already moving towards. All right, this isn't for you guys, it's for title people. But we are going to take a look at the form real quick.
I have a question in the back.
Sure.
This is the average closing fee. So we could do a flat closing fee. Could you do a separate one for construction, one for first-time home buyer?
As long as they meet the requirements and you charge it for every time. So every time it was a first-time home buyer and it fell to that type of transaction in that class, it would have to be used. Absolutely. I live in Chicago, and I've been there about 12 years now. Raleigh, software is headquartered in Raleigh. I work remotely, and I work from home, which is great, especially with this winter. However, we don't do a lot of average cost pricing anymore due to legal issues in the past. So I would be surprised to see them go back to it in Chicago, but a lot of people found themselves in trouble with recording fees in Chicago, which I'm still not even convinced anything gets recorded in Chicago. But I mean, what is it, March, right? I refinanced last June, I still don't have my paperwork. Yeah. I bought 3 houses in Chicago, and usually it's a 12-month turnover, so we'll say, what, a couple more months before I have to call? Okay, so here's our closing disclosure. And also sheet have in front of me, so I don't have to keep turning my head around. All right, this is the new 5-page closing disclosure form. It's very, very pretty. It's very, very consumer friendly. I mean, if you really stop and look at this and you really take yourself out of the industry, if you've never bought a home and you don't really truly understand the mortgage and closing process, this is by far the most user-friendly consumer closing form you have ever seen. And that's what our intent was. I mean, this didn't just come out lately. It went through 7 rounds of testing. It went through, I think, 11 iterations before you finally got to this form. They spent more time on this form and creating it than they did in writing the rule. You know, and because this is what the end result is. It kind of seems ridiculous to me at first, but then I realized, well, I guess not. This is the end result. The final rule is just kind of the rules behind this. This is what the consumer sees. This is what is going on record. So it kind of makes sense that they spend so much time on it. And it is a completely new form than what we're used to seeing, right? This is no HUD. So if you're cool, you want to be cool, if you know what you're talking about now, when people like talk to you about something, you'd be like, oh, the CDF. That's what closing disclosure form. That's our new acronym. So you got your closing disclosure form up at the top here. It says this form is a statement of final loan terms and closing. Compare this to the document with your loan estimate. So it's telling the consumer right off the bat, compare this to your loan estimate. Quick funny story. Back when Ben Olson was at the beginning, this is when we had the proposed rule had just come out. He was in charge before Rich Horn. We went out for a meeting to the CFPB, the Office of Task Force did, and we were talking to them about that particular statement and then something else to do with the GFEs, what we now know as GFEs. And they were like, well, yeah, I mean, then they can take the one GFE they got to, you know, the one closing statement. And I was like, they need more than one GFE, and they get more than one closing statement. They had no idea. That's when we learned early on that they had no idea that anybody would get more than one document ever. Like, they didn't understand the whole change circumstance. They didn't understand how they could have shopped around and then came back 2 weeks later, and therefore they got a new GFE because rates had changed and all different types of stuff. So it was very, very eye-opening. In fact, they did a survey 2 days after that meeting, a survey monkey, to the industry as to how, on all of your last closings, how many GFEs and closings or HUDs did you receive? Because I don't think they believed us, and so they really wanted to get a claim. And then that's when they went and said, oh, okay, yeah, this is a little bit more difficult than we'd originally thought. So they definitely did their due diligence. They definitely reached out to trade associations and groups, but I think originally they kind of thought it was a more straightforward process, which quickly explained was not. All right, so the top portion of this form is very similar to the top portion of a HUD, right? This is kind of the who's who. This is your, you know, closing information, transaction information, and loan information on these 3 columns. Date issued is a new date. Do not confuse that with a confirmation of receipt or the delivery date. I still don't have any idea what this is for. It's just required. It means nothing. It doesn't mean this is the date we gave it to the consumer, because I could print it out today and they're coming in tomorrow to pick it up, right? So don't get confused if that's going to, you know, count as your confirmation of receipt or delivery. It's just required. You have closing date, disbursement date, settlement agent, filed property, and sales price. So the settlement date or place of settlement is no longer required. And that's probably a good thing, because they don't care, because there's so many like e-notaries or traveling closings and stuff, and they said, you know, we did hear from the industry that sometimes we don't know where it's going to close until the last minute, and now I've got to give this to them 3 days ahead of time. I don't want to have to change the form on something so silly. So they took it up. It's no longer required. So you have transaction information, borrower, seller, lender. You notice you guys don't have an address anymore, right? That's because if you look at page 5, all of your information is in a contact grid. So they're saying, here's everyone that had anything to do with your file. If you have a problem, call them, or if you have a complaint, call us, and here's all their information. Yes. So it's not all up here on the form. Loan information, you have loan term, purpose, product, loan type, loan ID, and mortgage insurance case number. Very similar to what we have now, except they did ditch the is it FMHA and rural housing, right? That's gone. But you can still put anything in there under other. They just, since it's not really common in most areas, it falls under other. It's not hard-coded in there. Fixed rate, product. You can have a 5/1 arm, step, seasonal payment, you know, all the crazy stuff that's out there. You don't have to list it all there. Really, the only thing that fits, because it goes into more detail down at the bottom, so it's pretty big. You just really, what can fit can fit. That's why there's an extra line here, because if there was additional verbiage that needed to go in there, it could. So then you have loan terms. So I don't need my clicker anymore. Loan terms has 2 columns. You have the terms over to the left, and then can this amount increase after closing over here. So this is obviously some of the information that they're getting on their loan disclosure form based on the loan type that they're being quoted. So you have your loan amount, your interest rate, your monthly P&I, prepayment, and then balloon. So you have two different questions over here. It says, can this amount increase after closing? So their loan amount can increase, their interest rate cannot increase because we're dealing with a fixed rate. If this was an arm or a balloon or anything like that, it would say yes. And when it answers yes, it then directs somewhere, with more information. So an example of that is right here. Does this have a prepayment penalty? Yes. And then it goes into details. So if it goes into details on the interest rate, it'll disclose to them like when, so there's days or months and years and can never go as higher than this or lower than this. So it does fill in a good amount of information. It's all information that we disclose now, it's just in a different format. It is, however, not information that's in the title production software now, which will be in 2015. So, if you send this as part of your loan instructions, it's basic data entry for them because the system will calculate everything. Then you have projected payments here at the bottom. You have 3 columns, but it's not limited to 3 columns. You have your projected payments over there. So your payment calculations, you're going to take what's your principal and interest, your mortgage insurance, and then your estimated escrow. It also does say the amount can increase over time. There's a lot of good, actually, little, I call the italicized notes that actually are good for the consumer that we don't have now. Kind of gives a little bit more explanation on some things. But we have over here years 1 through 7. So it's saying your principal and interest is $761.78, and then years 8 through 88 is going to stay the same. So when this first came out, I was like, not all loans are 30 years. Why is it 1 through 7 and 8 through 30? Like, I hadn't read everything yet, obviously. And then I couldn't figure out why the amounts were different, which I shouldn't tell people, especially if you're talking to you. Then I was like, oh yeah, it's because they're assuming after 8 years you've dropped your mortgage insurance. Seems pretty logical, it's right in front of me. But this can go up to 4 columns. Okay, so based on the loan type, it can expand to 4 columns. Now there's going to be some loan products that are more than 4 columns. So the way that the CFPB put it in the final rule is you're going to list out the first 3, and the 4th one would be the last payment information. So the last year of the loan with the last payment information, kind of like an aggregate of all of it. So again, the systems will do all the work. It'll be based on the information that you send to the settlement agents, what you put in, and it'll allow them to go up to 4 columns. You have estimated total monthly payments right here for the different years. And then down here we have estimated taxes, insurance, and assessments. I actually really like this part because having been on the title side of things, people call you like, yeah, it's got a lien put on my house because my HOA dues aren't paid. I thought that was going to be paid out of my escrow. So here it kind of explains to them what is and isn't going to be in their escrow. And then on page 4, I think, there's a detailed escrow section that we'll look at. But it tells them amount can increase over time. See page 4 for details. So it says this is what your average cost per month is going to be for these items. Property taxes, homeowner's insurance, and then it says, is it in escrow? So it's saying yes to property tax, yes to homeowner's insurance. This is other, it says HOA dues, and it says no, this is not an escrow. So it's letting the consumer know that even though it's not an escrow, it's still part of their monthly fees that they need to worry about paying. This can expand down, so you can list more than one item. Sometimes you might have management fees, you might have, depending on the area, other fees that aren't being escrowed as well. This verbiage is required. It'll preprint on the form. Then we have cost at closing. I kind of like this. the first thing the consumer wants to see on page 1 is how much money they need to bring at closing, right? That's what every consumer is waiting for at the end when they're ready to close. 3 days before closing, quite honestly, all they want is their bottom line and what time they need to get their keys. So, down here on the bottom it tells them, here's your closing costs and here's your cash to close. The closing cost is broken down into the 2 sections on the next page, which we'll look at, which are loan costs and other costs, which are essentially your backside of your HUD, your page 2 of your current HUD. And then it does say, no lender credits in this case, and then it says, see page 2 for details. So then cash to close is the total, and then it says, this includes closing costs. And then see calculated cash to close on page 3 for details. So even though things are kind of scattered, it does at least give the consumer a little bit of reference points as to where they can find stuff. Does this mean that they're not going to call you or the title companies? Obviously not. They're still going to pick up the phone and call you. But at least you, when you're talking to them, can direct them to the same place that the CFPB in the form has directed them. All right, so then page 2. This makes perfect sense to me too. This closing cost details. Go down a little. So right now when someone does the closing, they've got a 3-page done, right? And they sit down with the consumer and they say, okay, now flip to page 2. Which makes no sense to the consumer. So they flip to page 2 and they say, now flip to page 1. We'll finish this. And now we're going to go to page 3 and go over your GFE stuff. So it doesn't flow right. This form does. This form is like if you were sitting down at a closing, these would be the next fees that you would go over, right? So you have your loan costs. I said this is very different than your current HUD 1, but this is essentially your new page 2. You have loan costs, and if you look further down, it's other costs. That's how it's split up in the system. So anything that they feel has been a cost associated with getting the loan or closing on this loan is going to be in their loan cost. And then other fees are going to be under other costs. So we'll kind of go through them and talk about them. So you have A, B, and C. These are take your place of your 800, 900, 1,000. They're all letters. And within each one, you have like 01, 02, 03, so on and so forth. Remember, you have alphabetized unless something has a permanent home. So under A01, you have your loan origination fee. But then under that, application and underwriting, 2 and 3 are alphabetized. If you jump down here to section C, you'll see you have pest inspection and survey. But then you'll also see you have title fees, right? We know they're title fees because, well, they all start with the word title dash and whatever the fee is. So anything associated with title, whether it be a settlement agent fee, a title search, a commitment, a binder, a CPL, anything like that, lender's owner's policy, all has to start with the word title. So you can see everything's alphabetized. It is very easy for a consumer to look and find something due to the alphabetizing. It's, not my vote, but definitely easy. We kind of go back to pre-2010, right? Itemization. No more roll-ups, no more looking like you're charging one giant fee for something when you're not, because it's really 7 fees rolled up into one. So to me, at least, and then also in all the testing, the consumer preferred this. It said it was a lot easier to see what they were paying for and how much they were paying for it. So we get to go back to itemizing fees. It does roll up on each one, but that doesn't push anywhere. It's really just for our purposes and for explaining it. Also, you'll notice we have a new column. Well, we had to have a whole new column here, right? The seller. The seller is actually allowed to be on this section again, unlike in 2010. So we also have this before closing section, which is nice, because right now when we have any what we call POC items, you've got to kind of find a place for them on that HUD 1, right? Usually it's over here and it says POC, $780, L for lender, B for broker, so on and so forth. But now they have their own column. So if the buyer paid anything before closing, then put it in here. If the seller paid anything before closing, you put it in here. If it was paid by others, it will go over here. And then you can mark L for lender. So if the lender paid for the appraisal fee, and it was $450, you put $450, L paid by other. In this case, I think it's $405. If the seller is paying fees on behalf of the borrower, you can put them in the seller column, just like pre-2010. Because in 2010, remember, we couldn't put anything on that. So anything to do with the loan could only go on the borrower side. You could do a credit debit on the front side of the HUD, but it was confusing. It was very, the buyer would look like they were getting charged for a lot of stuff, and you'd have to sit there and say, yeah, but wait till you get to the next page. We're giving you credits for all that stuff. So in this case, we can go back to pre-2010. Sometimes the contract reads they'll pay up to $1,500 because we don't know exactly what fees the borrower is going to be charged and which ones the lender will allow the seller to pay based on the type of loan. Certain fees the borrower has to pay. So in this case, you'd be able to go ahead and push them over to the seller side, tallying up to $1,500 or under, based on the amount of fees. And then you still can do a lump sum closing cost credit on the next page. So if the contract reads the seller's paying $2,000 in closing costs, we don't care what they are, and the lender just wants a lump sum closing cost credit, it can do that as well. So any seller fees you would put here, they paid on closing, and then like I said, paid by others. Anyone who's paying something outside of closing on behalf of the borrower can be disclosed here. B and C, services borrower did shop for, and services borrower did not shop for. So you'll see they're right here and here. They're alphabetized, they're charged, and in this case, looks like they paid the credit report before closing. So if you look at it from a consumer standpoint, it does make sense. It's obviously, if I'm looking at this with no help, paid before closing makes perfect sense versus a little POC with a dollar amount, little asterisk next to it, so we can remind ourselves to talk about it at closing. We keep looking further down, you'll see it's section D is your total loan cost. It does not tally or total anything but the borrower. You'll notice it's all blank. This is a borrower form. This is a consumer form. Very interesting that the seller really has no place in here. They don't even have a signature line, which we'll talk about in a minute here. But it's also chock full of borrower consumers loan information, right? So it's unusual, it's not like your current HUD, but it's required. However, it's not required to be given to the seller. You can use a different form for the seller. There is a seller version of this that has seller-only fees. You could use a master settlement statement. As long as this is used and signed by the court, it doesn't even have to be signed. As long as this is used and given to the consumer, you can actually have another form that you sign at closing as well that's got seller and borrower information. You just have to use this as well. All right, so down here on the bottom we have our other costs. So we have E, F, G, and H. So E is like your current 1,200, your recordings. Then you have essentially your 900, your 1,000, which are prepaids and escrows. Again, if the seller is paying any of these, it would go in the seller column, or if a third party had paid them, it would go here. This form can do what we call expand and retract based on your software ability. So for example, we created the form so that if this is all we're using, it doesn't have to be on 8, it can bump up to 4. And the CFPB states in the final rule that that's okay. Any unused lines can, like, for instance, shrink. And then one of the reasons why I think they did that is because, one, fees are going to fall on different lines everywhere anyway because of the advertising, so it doesn't so much always going to fall in the same spot. And then B is, H is a very small section which now contains commission, owner's title, and then anything you would normally put in your 1300 section. So to avoid constantly being pushed to another page or addendums, you can expand and retract the different sections because the line numbers aren't going to be specific to specific fees like we're used to seeing now. So if the software can accommodate it, it can push up, like we don't have to show an empty line 5 here under F, we can 5 and throw it down here. The one requirement, however, is if you do that, say under loan costs, and then, so let's say you had a lot of loan costs, and it pushed this section down some, you can't split the sections, meaning this can't, like H can't be on another page. Does that make sense? All other costs would have to be on another page. You can't split loan costs and you can't split other costs by pages. So if you were going to have one really expanded section, whether it be loan costs or other costs, you would have, this is page 2, so loan costs would be page 2, and then other costs would be page 2B. So if they do expand past where they're going to actually break up the page, they just have to be split. And not anything a user would have to do. Once it reached that level, obviously a system would know and split the pages.
Will these be printed on a legal page?
It does not. It's a letter. All of this shading, bolding, rounded, all required, unfortunately. I just seen like little details. I think when I started asking about that, they were like, what? I was like, oh, that's a big deal from the software and a coding standpoint. Printing, emailing with the shading and stuff. Maybe not emailing, but faxing and all that. It's a lot more to print too, but it's all required. I don't think it's a different placement, but there's not much changes. I will say down here at the bottom, and I don't know if you guys care about this, but I'll note it, under other, I just said, remember that you've got, this is where your commissions are. There's no more $20,000 in commission, last deposit retained, that confusing thing for the consumer. I don't know if this really applies to you guys. That goes away. That's actually shown on their calculated cash to close section. They show their deposit, and that's it. They don't have to do any of that. That rest of right goes away. You'll notice that owner's title insurance is down here at the bottom. It's not with the rest of title fees. It's because it's technically not required, which is why it says optional. It has to say optional on your loan disclosure form, and it has to say optional here if the consumer is paying for it. However, if the seller is paying for it, then the verbiage optional drops off this form because it's part of the contract, which is very common in most areas that the seller pays it, which is a nice change in our current form. You have to charge it to the borrower, credit it back to the, so here you would actually just put it in the seller column, drop the word optional, just like we would have pre-2010. There is also no agent underwriter split in this section like the current 1100 section requires. Again, I know it probably doesn't really affect you guys, but you're used to seeing it, so that won't be there anymore. Let's see if there's any other big changes. Charge to the seller, put it in there, there's their commission. Again, if they're paying it outside of closing or behalf of the borrower, you put it here. Totals up, only the consumer's fees. We're not so concerned about the sellers right now. And then their total is right here. If there's a lender credit, if you guys are giving it just a bulk lender credit, let's say $1,500, this is where this would go. And then it would then factor in the cash to close and also factor in on the calculated cash to close section. All right, so the next page, there's nothing new except the top. Not much, except the whole top, right? Calculated cash to close, this is kind of like page 3, at least of the top portion of your current GFE page 3 of your closing statement. It's a lot prettier, it's a lot easier. You know, right now it's all itemized, right? That page shows here's all the fees you were quoted, here's what you're actually charged. The itemization doesn't matter simply because it's an aggregate. I mean, the 10% isn't based on one particular fee, it's based on everything that falls in that bucket. So that's why it's not spelled out here. So you have what you recorded on your loan estimate and all of the fees. You see there's that deposit too. You have your final and then the difference. Did this change? If the answer is yes, it tells them where to look on the form to see why and maybe how it changed. And if it didn't, then of course it just says no. So it's very similar to what we have. It's just smaller, cleaner, and less detailed information. The bottom portion of this is just like your current page 1 of your HUD. Now, one thing I'll just point out, because it might look different when you see it, I can't remember if they have an example in here. Yeah, they do. Okay. So everything in here is pretty much the same. The numbering is different, of course. However, I will point out these credit debits are not on the same lines anymore. Seems silly, but it is a coding nightmare. So we're dealing with that right now. We have a whole team just on that. But here, they can put a credit on, a seller credit on L05, but instead of showing up on N05, like it would in today's world, it shows up down here on 08. And these are the lines they always have to be on. So they're like, we can't change that. So it looks different. The only reason I'm pointing it out is because these are the things I know that you look at when you're looking at a final HUD. So here you'll be looking at a final CDF, and it's on there. It just doesn't line up like it does right now. Bottom portion of this, you've got your taxes, you've got your calculated cash to close to and from seller, pretty much exactly what we have right now. And then the last 2 pages are just that. They are all disclosures. So most of this information is coming, well, all this information is coming from you all. You have your loan disclosures. Is it assumable? Is there a demand feature? What's the late payment? Is this a negative AM? Over to the right, I said we have more details on our escrow account information. You've got your partial payments, security interest, all of that information. Will you have an escrow? Will you not? What's included? If you don't, it's because you declined it or your lender doesn't offer one. You must declare the cost. It does give a disclosure here that in the future your costs may change, your payments may go up or down, you're responsible for it. So this is very similar to all the disclosures that you guys have to give already right now. And it carries on over to page 5. Page 5 also has loan calculation. So this is essentially kind of like your till. It just looks this way instead of this way. We've got your total payments, your finance charge, the amount financed, your APR, and your tip. Did anyone ever see the cost of funding that was on here before, that they removed from the final rule? That was ridiculous. It was very misleading. It was a very low interest rate on what it would cost you to do this loan that you would disclose to the consumer, which is very misleading because you didn't borrow $200,000 for them, you borrowed $2 million and got a lower rate. That's why you were able to give them a portion of that. So the MBA thought really hard, so did Alta actually, to have it removed, and they did take it out and it's no longer required. So that was good. Appraisal, contract, liability after foreclosure, refinance, so on and so forth, all just hard-coded, nothing anyone would have to type. Questions. That giant question mark is actually required. Like we have to have it exactly as is. If it says if you have any questions, contact your lender, see below. So here's everybody in your file. And then they go on to say, what if you have a complaint? Go to consumerfinance.gov, mortgage closing, and then give us their information and we'll look into it. So, it could be helpful to have all this information right here. If someone has a question for the lender, your information's right there. If someone has a question for the real estate agent, it's right there. If they have for the settlement agent, it's right there. They're obviously going to call you most likely the person they feel most comfortable with, just like they do now, but at least all their contact information is right there. It's not just their contact information, it's state license IDs, MLS IDs, so on and so forth. This can go one more column. If there's like 3 real estate workers like they have out west, you can add an additional column. If there's anything further than that, it has to have an addendum. And then the last thing here we have is confirmation of receipt. By signing this, you're saying that you received this form. You do not have to accept this loan because you've signed or received this form. It's no different than a HUD. A HUD is just acknowledging that they got the form and that they agreed that the numbers are correct, but they're not accepting the loan until they sign the note, right, for the mortgage. This is not required. No signature is required on this form. If they check that, if the lender says, I don't care, I don't want this signed, I don't need this signed, then this disappears, and then up above the contact section, a new disclosure pops up saying that you've received it. It's basically the same thing, but they dropped that you've signed it. It's just another disclosure saying we've given you this form to review. You can add signatures. If they don't fit here, then it can just be like a HUD one right now where you can have an acknowledgement page or a signature page. And you can certainly add seller signatures. If this is going to be the final closing document form, and then you would clearly want to have seller sign this as well. So a lot of people have talked about adding an additional signature page, and then essentially only giving the seller pages 2 and 3, and having the consumer get all 5 pages, simply because the seller doesn't need anything to do with page 1, 4, and 5. So the signatures are up in the air. It's required that they get the form. It's not required that they sign it. I imagine most people would want them to sign it. But how they sign it and if they have the seller to sign it is up to the way that they do business. Did you have a question?
In the contact section, what if the transaction is a bifurcated transaction? Do you not care if who the seller's title is coming, because they're paying for
No.
the buyer? But the buyer is actually winding up with the policy, so
Yeah.
they wouldn't have.
You can add it. It's not required. If that answers your question. You can certainly add it so that you can add all additional parties, but if you look at the final rule, it will specifically list out who is required, and this is that. Yes, ma'am?
So this is disclosed 3 days prior to closing?
Correct.
Does this have to then get re-signed at the closing table, or
It
is
doesn't
that
even need to be
first?
signed at all. This just needs to be
So
delivered.
this replaces the HUD. This is the only thing that itemizes what they're being charged, and they don't necessarily have to sign it.
They don't technically have to sign a HUD right now. If you look back at the rules and regs, they didn't even sign it originally, and that's where the whole acknowledgement of signature pages came from over time. They're not required to sign a HUD right now, it's just a disclosure form. They're required to sign a note and mortgage in order to get the loan. Would I ever do a closing without them signing it? No, but they're not required to sign it right now. This form is required to be given to the consumer. Whether the settlement agent or title company want to use this as their final closing form is up to them. If I'm in an area where we're doing, table funding, both parties at the table, I'm probably not going to hand off 5 pages of this to a seller, because I would not want the borrower's loan information, personal information, given to the seller. Would I give them pages maybe 2 and 3 along with the signature page to sign off on? Maybe. Or would I just give this to the consumer, have them sign it, and then I would have basically a master settlement statement that I would have both parties sign. So as far as that final, this is required. It does replace a HUD 1 and final till. There's no more that 3-page HUD 1 with the GFE. But you can certainly have a top sheet that both parties sign. A lot of people will use what we call a master settlement statement, which is almost like a T-chart with money in, money out for the buyer and seller, and they sign off on. So it's all the same information, it's just in a more, 2 and 3-page information. We wouldn't have any of the borrower's information. It'll vary just depending on the region and the way people do business now.
Is it still then the lender's discretion to require this as part of their funding package?
This
Versus a HUD?
This is required by the CFPB. So if I was a lender, yes, I'd want to see that this was done correctly and that we have a copy of it. But you might also want an additional top sheet with it. I don't know. You might have a different
So
sheet
there
than your
is some
car
discretion on
funding.
the lender's part. Because in our normal scenario, lenders are requiring a final HUD be approved before they'll release loan documents, and then at closing, send that same final HUD signed in order to authorize the use of their funds or to get a funding number. So if the CFPB is not requiring any of that part of stuff, that would be
Yes, that would be your internal, absolutely.
internal, okay,
Yeah.
requirement. of
And remember,
the
this is required 3 days before closing. There may be changes to this a new one may be given at closing. So if the dollar amounts change but don't kickstart into a 3-day waiting period, you still have to update it and change it and give it to them at closing, but it doesn't require any 3-day waiting period or anything like that. So I mean, the final version of this has to match whatever form you require. The numbers have to match. This is what's on here as well. But you know, you can absolutely still say, but we require this form in order to get funding. You know, a top sheet or master settlement statement or whatever you're approved. That is just another form.
I just want to make sure, currently, we only get a GFE if it's subject to RESPA. Now, when we had read these initially, there's no differentiation between subject to RESPA or not, so this applies to all consumer loans?
No, one of the first things we went over were the loans that don't apply to it, like a reverse mortgage, at home equity, commercial, seller financing, mobile home not attached to land. So there are still some, and that's in the beginning part of the rule. There's a section on specifically tells you which loans are and are not governed by this.
So like over 25 acres, we now need a GFE.
You know what? I can't answer that. I don't know. I haven't gone through all the loan types that you would need to give a GFE to. Maybe Cory can, I don't know. Yeah, but there is, you know, there is. In fact, if you do 5 closings less a year, you don't fall under it. So there are some. There's like a chart in there that you can pull up and you can see it, but that there are definitely some that don't fall under it. I just don't know them all offhand.
And then you do the old?
You could use whatever you want. I mean, because mostly right now what people do because they don't fall under the 2010 rules, they go back and use the pre-2010 because it's so much easier, or they use master's settlement statements and Orange Juice HUD 1. So depends on your lender, well, you are the lender or the realtor. They, you know, depends on what they require. If it doesn't fall under the requirements of this, it does fall back to RESPA requirements, like a reverse mortgage has to fall under the 2010 rule document for now. You can't use the pre-2010 for the reverse mortgage, you have to use 2010. But they're all a little bit different, so if it doesn't fall under here, then I would revert back to whatever is required right now. Or shoot the CFPB an email. They will respond to you, I promise. To say, you know, these are the ones we're concerned about, where do they fall? But they do give very specific examples in the beginning portion of the rule and what they fall under and what type of forms need to be used. You can find these forms, by the way, in the seller model form and then other various, there's also, if you go to cfpb.gov, or consumerfinance.gov, I'm sorry, consumerfinance.gov, there you go to the know before you own mortgages. There's also, give you forms for different types of loans. They'll give you model forms for different types of loans instead of promulgated forms, so that you know that you don't have to use this. Any other questions? And Cory has some stuff to say. Not much. She told me to